Hello and welcome to the Morningstar series, Ask the Expert. I'm Emma Wall and I'm joined today by Hortense Bioy, Director of Passive Funds Research for Europe. Hello, Hortense.
Hello, Emma.
So you're here today to tell us about the importance of understanding what you're buying before you make a tracker fund or ETF purchase. And this all comes down to the underlying market that product is tracking. So, for example, a lot of people, when they want to buy the UK market, look for a FTSE 100 tracker or ETF. But you're saying that might not always be the best choice.
Absolutely, absolutely. If you buy a FTSE 100 index funds or a FTSE 100 ETF, basically what you are getting exposure to is only 100 stocks, which, yes, represent 85% of the UK stock market, but it is a bit narrow. I think if you want comprehensive exposure to the UK stock market, you will be better off with a fund that tracks the FTSE All-Share. The FTSE All-Share has 600 constituents and represents 98% of the UK stock market. So you're really buying the whole of the UK market. Also, it is, because it has 600 constituents, it is broader. It is also more diversified. It has a 20% allocation to small and mid caps. So it is less concentrated at the stock level, but also at the sector level. So you don't get exposure, for example, so much exposure to energy stocks or mining stocks.
And that's not just the case in the UK, is it? The same mistake is being made in Europe and in the US.
Absolutely. I mean, if you take like the best known, most widely followed benchmarks, like we talked about the FTSE 100, but also there's the CAC 40 in France, the DAX 30 in Germany, or in the US, the Dow Jones Industrial Average, or even in Japan, the Nikkei 225. I mean, it's important to remember that those benchmarks were created by stock exchanges. So they were originally designed to represent or to measure the performance of a stock market, and usually the large cap segment of a stock market. And often, as you said, you know, investors tend to associate these benchmarks with the market. They're saying this is the market. I would say while these indices are probably very useful to measure the performance of a manager, to evaluate its performance, it might not be the best idea for the long term. Because these indices are not the best representation of the underlying market, of the whole opportunity set. And there are many more indices that are probably better representation of the asset class you're targeting.
So then, for example, in the US, instead of the Dow Jones, what should we be looking at? So
like a broader index would be the S&P 500, which, as we know, has done very well in the past few years, or even a US total market index. These are better representation of the whole asset class, and is probably a better ideas for someone who is looking for broad exposure to the US market.
And that's often how people use ETFs and trackers as well, at the core of their portfolio, where that diversification is, of course, very key. Perhaps you could give us a few examples of trackers and ETFs that do offer exposure to these broader markets.
Yes, absolutely. I mean, I've got in front of me 3 examples of index funds that actually we rate silver, that gives exposure to the UK market, and they track the FTSE All-Share. So we have the LNG UK Index Fund, we have the BlackRock UK Equity Tracker, and the Vanguard UK All-Share. So as I said, you know, they rated silver and they track the FTSE All-Share. There is also an ETF, the Spider FTSE All-Share ETF, that is quite cheap at 20 basis points. And for US equities, we rate the Vanguard US Equity Index Fund, and it is rated gold. So it's a total market index. And for the S&P 500, I would just name the iShares Core S&P 500 ETF, which is a very cheap ETF.
Hortense, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.